Back in March of this year, U.S. two-year Treasury yields eclipsed 5% for the first time since 2006. Now that level didn't hold long as news of a crisis in the banking system hammered yields across the curve, and the two-year fell from 5.07 to 3.80 in a matter of days. Now last month, on August 18th, the two-year crept above 5% again. And although it had a couple of pullbacks, it appears to be forming a technical base at that psychological level. Of course, the story now is much different than it was back in March. Now the belief is that inflation is subsiding, and more importantly, economic data is holding in fairly strong, leading many traders to believe that the short-end rates can be held higher for longer and that a recession can be avoided. On September 20th, we have the FOMC decision, and the market probability for a rate hike stands at only 1%, according to the CME FedWatch tool. Now, interestingly, the futures market still says there's a 29% probability of an additional 25 basis point hike at the November 1st meeting. Of course, that meeting comes after we see another round of CPI numbers on October 12th and the PPI on October 11th. Now, if a trader believes that the recent strength in yields means they could continue higher, they could express that by buying the September micro two-year Treasury yield futures contract at 5.04 and target a move to the next psychological level of 5.25. A stop for this trade could be placed below at 4.89. Now, this trade can make $210 if the target is reached and risks $150 if you're stopped at your level. Now, if a trader believes that yields could fall from here, they could express that by selling the SEP micro two-year Treasury yield futures contract at 5.04 and targeting a move back to the July lows of 4.65. A stop for this trade could be placed above at 5.32. Now, this trade could make $390 if the target is reached and risks $280 if you're stopped out of your level.